Gold and silver are not just moving because traders feel nervous. They may be moving because the market is being forced to price in something much bigger all at once. War risk is climbing again. Oil is no longer acting tame. Inflation pressure is threatening to come back through the side door. And if those three forces start feeding each other, then the move we are watching in precious metals may not be a bounce. It may be a repricing. That is the real story here. Not a random rally, not another one-week panic bid. A possible reset in how the market values protection, energy, and purchasing power at the same time. And most people still are not looking at it through that lens. Because when people hear gold is rising, they usually think fear. When they hear silver is rising, they usually think speculation. But that framework misses what happens when oil, inflation expectations, bond stress, and geopolitical uncertainty start moving together. In that kind of environment, metals do not just attract momentum. They start absorbing distrust. And that is where this gets dangerous for anyone still treating the current move like noise. The first layer of this story is obvious. War risk changes pricing fast. The moment markets believe a conflict can widen, shipping routes, insurance costs, energy flows, and commodity hedging all start shifting before the headlines fully catch up. That matters because oil is not just another chart on your screen. Oil is embedded in transportation, manufacturing, agriculture, logistics, plastics, chemicals, and ultimately, consumer prices. If oil moves hard enough, it does not stay in the energy sector. It leaks into everything. That is why even a small disruption can matter more than people expect. The market does not wait for shortages to become visible at the gas station. It starts pricing the possibility of tighter supply the moment traders think a key route, producer, refinery, or export corridor could be hit. The price reacts first. The economic pain shows up later. And that delay is exactly why investors get trapped. They look at today's inflation print and assume the story is calm. They look at central bank language and assume policy has everything under control. They look at a temporary pullback in yields or a quiet session in equities and think the system has stabilized. But oil-driven inflation does not always announce itself politely. Sometimes it disappears for a few months, then returns through input costs, freight costs, fuel surcharges, utility bills, and food prices. By the time the public feels it, smart money has already repositioned. That brings us to gold. Gold does well when confidence in paper promises starts to crack. It does well when investors believe real rates may not stay restrictive enough. It does well when governments need to spend more, borrow more, or respond to shocks with more liquidity than they previously admitted. And it does especially well when the market stops believing inflation will glide neatly lower without any interruptions. Now add war and oil to that picture. If conflict risk pushes oil higher, central banks face a nasty problem. They can stay tight and risk slowing growth harder into a fragile economy, or they can tolerate more inflation than they want in order to protect employment, debt markets, and financial conditions. Neither option is clean, and markets know it. That is why gold often starts moving before the policy debate is settled. Gold is not waiting for the final speech. It is front-running the credibility problem. But silver is where this gets even more interesting. Silver lives in two worlds at the same time. It is part monetary metal, part industrial metal. So when fear rises, silver can behave like a smaller, more volatile version of gold. But when inflation pressure reconnects with energy costs and manufacturing expectations, silver also picks up a second bid. Suddenly, it is not just a safe haven conversation. It becomes a reflation conversation too. And that dual identity is exactly why silver can look quiet for a while, then move with shocking speed once the market finally decides which story matters more. Think about the sequence. First comes geopolitical tension, then oil firms up. Then inflation expectations stop falling as quickly as everyone hoped. Then rate cut optimism gets questioned. Then the market starts wondering whether nominal yields are high for the right reason, or whether they are simply failing to protect real purchasing power. That is when gold catches attention. And once gold starts leading, silver often follows later, harder, and more violently. The average investor usually enters too late because they wait for confirmation that feels comfortable. They want the conflict to be undeniable. They want the oil breakout to be obvious. They want inflation to show up in multiple reports. They want central bankers to admit the problem. They want metals to already be trending. In other words, they wait until the repricing has already happened, then call it obvious. But markets do not pay you for obvious. They pay you for being early without being careless. So what exactly could the market be repricing right now? It could be repricing the idea that inflation was beaten more cleanly than it actually was. It could be repricing the assumption that energy shocks are temporary and manageable. It could be repricing the belief that monetary policy can respond to any new stress without consequences. And it could be repricing the cost of being wrong about geopolitical stability. That last point matters more than people think. War does not need to become global to matter financially. It only needs to create persistent uncertainty around supply, transport, retaliation, sanctions, or military escalation. Markets are not pricing history textbooks. They are pricing probability distributions. And when those distributions get fatter on the upside for oil and inflation, metals do not need perfection to rise. They just need the old disinflation confidence to weaken. This is where the bond market enters the story. For a while, many investors convinced themselves that falling inflation would give policymakers room to cut, support growth, and preserve asset prices all at once. That was the soft landing dream. But if oil rises while growth remains uneven, then yields can become much more complicated. Are yields falling because inflation is contained, or because growth is deteriorating? Are yields rising because growth is strong, or because inflation risk is returning? Those are very different worlds for portfolios. Gold thrives when that confusion grows. The more investors struggle to trust the real return on cash and bonds, the more attractive a neutral reserve asset starts to look. Gold does not need to pay yield when the system around it is creating uncertainty about what yield is actually worth after inflation, taxes, and policy reaction. And silver, again, sits right behind it, waiting for the market to decide that the move is bigger than a temporary hedge. There is another angle that most people miss. Energy inflation is not just about the consumer, it is about margins. If oil, diesel, electricity, transport, and feedstock costs rise again, companies face renewed pressure. Some can pass it on, many cannot. That means the market is not just dealing with inflation as a macro headline. It is dealing with the possibility of margin compression, weaker earnings quality, and more fragile equity valuations. That creates a second reason for metals to strengthen. When investors no longer trust that stocks, bonds, and cash are all positioned correctly for the next phase, capital starts looking for assets that sit outside the usual earnings and policy matrix. Gold benefits first because it is the cleanest expression of that distrust. Silver benefits next because once the precious metals complex begins to attract flows, silver's smaller market can move disproportionately. And that is when people start calling it crazy. But the move only feels crazy if you were anchored to the old regime. The old regime said inflation was cooling, energy shocks were fading, central banks were approaching flexibility, and geopolitical risk was background noise unless it directly hit GDP. If that regime is breaking, then yesterday's price anchors for gold and silver become less useful than people think. Markets can spend months normalizing under one narrative, then suddenly realize the narrative itself was the mispricing. That is how repricing works, not linearly, not politely, in bursts. Now, none of this means metals go straight up every day. In fact, the path is usually much uglier than the thesis. Gold can pull back on stronger dollar days. Silver can get hit by liquidations, leverage, and broad risk-off selling. Traders can confuse temporary position unwinds with broken fundamentals. That is normal. Repricing is not a straight line. It is a battle between old assumptions and new realities. And right now, that battle seems to be intensifying, because the market is being forced to ask a difficult question. What if inflation is not returning from excessive consumer demand, but from renewed geopolitical stress and energy friction? That kind of inflation is much harder to solve. Rate hikes do not produce more oil. Policy speeches do not reopen disrupted routes. Hope does not lower insurance premiums on vulnerable shipments. If that is the inflation path, then the playbook gets messy fast. Central banks hate supply-side inflation because it corners them. If they respond too aggressively, they hurt growth and risk financial breakage. If they respond too softly, they allow purchasing power erosion and unanchor expectations. That tension is one of the most bullish long-term environments gold can ask for, because it reveals the limits of policy control. And the moment policy looks less omnipotent, hard assets begin to look more rational. This is also why silver should not be dismissed as just a sympathy trade. Yes, silver often follows gold. Yes, silver is more chaotic. Yes, it can underperform for frustrating stretches. But once the market accepts that inflation risk, industrial stress, and monetary distrust are overlapping, silver gains a wider narrative base. It is no longer just the cheaper cousin of gold. It becomes a metal tied to both currency anxiety and real economy strain. That is powerful, especially because silver's price structure often magnifies flow once momentum builds. A market can ignore silver for longer than expected, then suddenly discover that liquidity is thinner than assumed, positioning is offside, and the move is feeding on itself. That is why silver rallies often look unbelievable in hindsight. They are not just about fundamentals. They are about delayed recognition colliding with a smaller market. So when people ask whether gold and silver may be repricing now, the deeper question is this: repricing against what? Against the idea that geopolitical disorder can stay economically contained, against the idea that oil can rise without reigniting broader inflation psychology, against the idea that central banks can always engineer a smooth response, against the idea that real purchasing power is protected simply because nominal policy rates are still elevated, and against the idea that the post-shock world has become safer, calmer, and structurally less inflationary than it really is. That is what may be changing. There is also a behavioral piece here that matters. Markets spent a long period rewarding confidence in disinflation, confidence in policy control, confidence in paper assets, and confidence in the belief that any growth wobble would bring easier money. That confidence created positioning, and positioning creates vulnerability. If the macro backdrop shifts away from that comfort, portfolios do not adjust instantly. They resist. Managers cling to old models. Commentators explain away the first move. Traders look for mean reversion. Then, if the move continues, those same participants are forced to rebalance into the thing they dismissed earlier. That transition can accelerate metals far faster than a purely fundamental model would suggest. In other words, the repricing is not just about economics. It is about psychology catching up to economics. And that is why this moment matters. Because once gold starts to tell the market that uncertainty is not temporary, and once silver starts confirming that the move is broadening, the conversation shifts. Suddenly it is not about whether metals deserve a bid. It is about whether traditional portfolios are underhedged for a world that looks more unstable, more inflation sensitive, and more policy constrained than expected. That is a very different conversation from the one most investors thought they would be having. They thought the story would be clean: lower inflation, easier policy, stable energy, selective risk-taking, controlled volatility. Instead, the market may be staring at a far more uncomfortable mix: geopolitical escalation, sticky energy, inflation doubts, and monetary hesitation. That mix does not just help gold and silver, it changes how they are valued. Because value in metals is never only about jewelry, industry, or charts. It is about trust. Trust in currency stability, trust in policy credibility, trust in supply chains, trust in the durability of disinflation, trust that governments and central banks can absorb the next shock without creating a bigger one somewhere else. When trust weakens across several of those channels at once, metals do not need a marketing campaign. They get rediscovered naturally. And if that rediscovery is beginning now, then the biggest mistake is assuming the first move explains the whole move. It rarely does. The first move is often the alert. The second move is recognition. The third move is capitulation by those who assumed it would fade. By the time the broader public sees it as a trend, repricing may already be well underway. That is why watching oil in isolation is not enough. Watching inflation prints in isolation is not enough. Watching war headlines in isolation is not enough. You have to watch the chain reaction. Energy pressure affects inflation expectations. Inflation expectations affect rate assumptions. Rate assumptions affect currencies, bonds, and risk appetite. Geopolitical stress affects hedging behavior across all of it. Gold and silver sit right at the intersection. And when an asset sits at the intersection of fear, inflation, and policy doubt, it can move for longer than consensus expects. So, where does that leave us? It leaves us in a market where precious metals may be telling a more honest story than many traditional indicators. Stocks can stay calm for a while. Policymakers can stay composed for a while. Forecasts can stay optimistic for a while. But gold and silver tend to react when the underlying confidence structure starts slipping underneath the surface. That may be what this move is really about. Not just fear of war, not just a spike in oil, not just one inflation concern, but the recognition that all three can reinforce each other, and that once they do, the old pricing framework becomes too cheap for hard assets and too generous for financial complacency. If that recognition continues, then gold is not expensive for what it is signaling. It may be early. And silver is not merely tagging along. It may be preparing for the part of the move where the market stops treating metals as optional and starts treating them as necessary. That is when repricing becomes visible to everyone. But by then, the easy part is usually over. So the real opportunity is not in pretending certainty. It is in recognizing when the market may be shifting from one macro regime to another. A regime where war risk matters more than forecasts assumed. A regime where oil can still destabilize inflation faster than policymakers can respond. A regime where confidence in paper returns is more fragile than it appears. And a regime where gold and silver are not old relics in a modern portfolio, but active signals that something underneath the surface is changing. That is the message investors should be hearing right now. Because if war, oil, and inflation really are back in the same conversation, then gold and silver do not need a dramatic narrative to justify higher prices. They only need the market to realize that the world is less stable, less predictable, and less disinflationary than it wanted to believe. And once that realization spreads, prices do not have to creep. They can reset. That is what repricing looks like. Slow doubt at first, then faster hedging, then a scramble for protection once the cost of waiting starts to feel bigger than the cost of acting. We may not be at the end of that process. We may be near the beginning. And if that is true, then the most important takeaway is simple. Do not look at gold and silver as isolated trades. Look at them as a verdict on energy risk, a verdict on inflation credibility, a verdict on policy flexibility, a verdict on whether the market still believes the next shock will be easy to contain. Right now, that verdict may be changing. And if it is, then gold and silver are not just reacting. They are warning. The market may still be debating headlines. Precious metals may already be pricing the consequence. And in environments like this, the consequence is usually what matters most.